And when you go through pauses in a trend, there is no better tool to understand what the probability that the trend will continue than what you are learning today. All the other momentum indicators, all the things you hear me talking about that Wells Wilder came up with, all of the other charting techniques, I find not as powerful as the one I'm teaching today. So let me just see how the weeklies closed in terms of some markets for those of you who for the last hour have been wondering how the week would close, because we use weekly closing prices on much of the work that I do. S&P came back nicely. The NASDAQ was up almost 3%, 277. Even the Dow, which had been up 400 points earlier and went negative during the day, closed up over 1%, almost 300 points. It's settling up now. Let me just take a look at a couple of quick other things, such as gold down 0.5% after that tremendous move yesterday. Okay, so things are still in line with what I've been saying on Twitter. We apologize for not doing more vlogs, but Leah spent a wonderful period of time in Southern California and then in Northern California, except for when I would bug her about doing all the work she's been doing, making sure that this went smoothly and as many of you as possible could get into it. We're very happy that there's still 105 participants. I thought as I droned on and on that would drop down to about 20. Maybe a bunch of people dropped out and new ones came in. I'm trying to speak as quickly as I can, so excuse me for that. All right, let's get into let's see if I can figure this one out now. I think I can. We want, oh wait, I think it's this one right here. This one. Can you see that, everyone?
Not screen share yet, Ty.
Oh, I can see it. So that's all that matters. Okay. So I bet if I made this small and then I did this again, and then I do this, and then I make this big. Can you see that?
Yep, looks good.
Touchdown. Okay. I only could do that because my son spent 2 hours showing me. Tone Vase and our friend Sweet Pig helped me last night. Okay. What you are looking at is the Dow Jones Industrial Average from left to right. Remember what happens on a chart. You cannot go vertical. You can only go angular or horizontal, because at the bottom of the chart is time. Everybody is very excited about this. I was very excited about this because this was a breakout to new all-time forever highs on something that I have studied price going back to the late 1800s. And this little beauty right here is the highest, biggest that there has ever been in the history of the stock market. A lot of people are nervous because of this. So let's take a look at what a trend really is. Now we're going to go back a couple of years. This is clearly a trend. I said it can go from the bottom left either angularly up or angularly down or angularly up. It cannot go straight up. It can do it for a short period of time, such as when this became the highest ever, but it can't keep going straight up, and it can never go backwards. It just seems so logical. Of course it can't go backwards, but understand why it can't. Because this is 1/4 of a quadrant that is plus plus. Over on the other side, to the left of this chart, is a quadrant that is plus on price, but negative on time. And below this chart is the quadrant that is positive on time, but negative on price. And horizontal to this, if you could take this trend down off the chart into a lower quadrant, everything is negative, time and price. Obviously. But why is that important? Because you're trapped. You're trapped in this little quadrant in which only certain things can happen, which explains why every uptrend ends. Show me any uptrend on a quadrant that's plus plus like this one that has gone straight up and kept going, or gone up at an angle and kept going, like General Electric, for example, that did it for decades and decades and decades and decades and now is crumbling into nothing. Was taken out of the Dow Jones Industrial Average after almost 85 years just recently. There are those that believe that Bitcoin will only go up and up and up and up. That will be the first time in history that's ever happened. So let's go back a little bit further and talk about what a trend really is. Now we're going back to a little problem area in which clearly we were flat. We tried to go down, we tried to go up, we tried to go down. I love this little button. And then we tried to go up, and then we went flat, and then we finally went up and a new trend started. This is a flat. Well, you say, no, it's not a flat. It keeps going up and down. I can make money going up. I can make money going down. I can make money going up. So you have just defined yourself as a speculator or a gambler, but not an investor. An investor can't make money in this market. An investor can make a lot of money in this market. So let's go back even further. We're looking at just one chart, the Dow Jones Industrial Average. Now we're at 2013, and we see one trend. It's up from the bottom left to the upper right. That is a trend. But I'm defining that trend from the point of view of an investor who doesn't want to jump in and out of things, but wants to know when is a trend going to be, according to Consensio, one that can go on for many months, quarters, or years, in which you don't have to watch the charts every day. You don't even have to watch them basically more than once a week And you can do that very quickly by simply getting rid of the price and using the moving averages, which we will demonstrate in just a second. Now, this particular chart is beginning just back in April of 2012. We had just come out of a tremendous downturn that we could look at if we wanted to look further back. If we do this, remind me that I want to take that off because I've just changed 75 charts. You've still got a trend from the bottom here which is the end of this tremendous downturn. It really didn't last very long, but was hideous. And this downtrend, which also was hideous, but lasted a long time, lasted 3 years, from March of 2000 until March of 2003. But other than that, if you come to this side of the chart, 1991, you've got one trend, which is an uptrend. I could go back to 1900 and you will see this same trend for the Dow Jones Industrial Average. From the bottom left to the top right, always going higher and higher. There are those that believe, I am not one of them, but there are those that believe that because this trend is so apparent over many, many, many decades, that should be the only way you look at investments. Buy and hold good stocks, good mutual funds, good ETFs. And that held pretty true in most of our lifetimes. But Edson Gould said 25 years before this chart that the problem is people don't recognize the difference between long, intermediate, and short-term trends. So they go through periods like this. That last 10 years in this case. And we will see later on the NASDAQ, I've shown you that lasted a lot longer, lasted till just a couple of years ago without getting back above where it was. I would look at this chart and I would say there's some great opportunities from 1990 to 2000, 10 years uninterrupted with this little squiggle down here, which was basically the Malaysia currency crisis along with long-term capital hedge fund basically blowing up and almost bringing a lot of banks and brokerage firms down with it. But even after that little diddly doodle, we still ran up in one of the biggest surges in stock market history. At least it was for the NASDAQ. Between 1998 and the year 2000, and that last year, 1999, the NASDAQ was up 84% in 1 year. And if you had gotten scared out because of this, you wouldn't have had that ride. If you hadn't gotten scared out and didn't realize what this was doing, remember it was March of 2000 where the NASDAQ peaked. The Dow kept going sideways months and months and months after the NASDAQ peaked before it dropped down. So I would look at this and I'd say there's one trend here, there is one trend here, there is, which is two, there's a third trend here, a fourth here, and a fifth here. 5 trends. And you needed to play all 5 of those if you were perfectly attuned to the optimal investment rules, you would be in, out, in, out, in, and still in today. And I will try to explain why and how I am making that comment. I said that you need to be able to define what you mean as a trend for who you are and what you're trying to achieve. I put what sounds like pejorative words on top of that. To me, gambling, talking about people trying to make money in the market, is not a pejorative term. It simply means that you're willing to jump in and out and in and out and in and out of positions. You cannot do that fundamentally. You have to do that technically. And you can choose your tools to do that with. And that's fine. You're basically flipping a coin, and you might get 6 in a row correct, and then 6 in a row not correct, or you might every other trade make money or lose money. So even though you're talking about a 50-50 proposition most of the time, you can make a lot of money if you learn money management, which is the size of your positions and the amount of loss you are willing to take compared to the amount of gains you are willing to wait for. That has nothing to do with technical analysis, and it has nothing to do with the size of the trends. It has to do with your ability to manage what you are doing using proper sizing and stop losses or other defensive tools that we will do an entire show on, a webinar at a different time. Okay, now what I need to do is I need to try to clean up my charts so that I don't irreparably screw up everything we've been trying to build. And we will do that by, first of all, leaving the monthly and going back to the weekly. The weekly to me is everything in analysis, mainly because I got married to it with my work in hyperwaves over the years. And since then, it's changed almost everything I do in terms of charting, where I wait for weekly closes. This is the current week we're in the Dow Jones Industrials. And you can see that we dropped down much further than we closed. And so we've got a little bit of a wick. Still, it's not a reversal, and it's a very negative close for the week, but we will break that down as we look at all the other charts. Okay, now what I'm going to do is I am going to put back on the moving averages, and I'm going to start with this itty-bitty one, which is the most confusing of the ones that I use, and a lot of people ignore it. This is a 3-week moving average, which doesn't tell you anything, basically speaking, as you look at it relative to price. And the reason it doesn't is because we're not talking about perfect sine waves. And each of these candles, depending on the size of it, will go well above that 3-week moving average or drop well below it. But it's important for me and Consensio because my very, very short-term averages that I use is the thing that makes me sit up and take notice that maybe something is beginning to happen. As long as price is staying within, above and below those averages, as it's either moving up or down, as it does in almost every case here, meaning each of the candles is touching somewhere on that pink line. then the pink line is doing what I want it to do. When you start getting candles above or below a line, then you are buying inefficiency in terms of what the line is supposed to be telling you. I needed to know on this kind of a move that the pink line was going to turn down. And just think about that for a second, what I'm trying to explain. And one way I can explain it better is to take that one off and go to the next biggest one, which I'm using, which happens to be a 7. Now, what you will notice when I just move out 7, in this case it's weeks, in terms of days on a 5-day business week asset, a 7 is equal to 35 days. On a 7-day asset like Bitcoin, I drop down to a 2 because a 2 equals 14 days, whereas a 3 on a 5-day is 15 days. The thing that makes me change a moving average is its relationship to price. I don't want any moving average to be so far above or so far below price as to be useless. Therefore, when I change from weekly to daily or 4 hours or monthly, I changed all the moving averages to bring them back in line to capture the movement of price during trends. Okay, you can see by going from that short one, and I'm going to bring it back up on the 3. And take it back off so we can just look at the 7. And notice that now in a uptrend, price stays above that 7. And in a downtrend, it tends to stay below that 7. In an uptrend above, it wasn't really an uptrend because it broke it, took 3 weeks to get back, and now it stayed above it. That's why my intermediate is designed that way on the upper right of a quadrant that only runs from the bottom left up to the top right, or from the top left down to the bottom right when a trend is in place. You need to match the moving average with whatever the asset is you're looking at. Stocks and indexes, individual stocks don't move the way indexes do. Individual stocks don't move the way mutual funds do. Individual stocks don't move the way Bitcoin does. And each one of them, you need to tailor Consensio for what you are looking at. This is not a difficult prospect. Simply do what I have just done. Get your short term to move through the middle of all the price activity. Get your intermediate term to stay in an uptrend below all the price activity. And stay above in a downtrend. Looking at longer periods, you can differentiate quickly between small corrections This one lasted almost 6 weeks, which if you were living through it seemed like an eternity. But notice that none of those individual candles were completely below that red line. That's the way it's designed. If it doesn't work that way for the asset you are looking at, in this case, we're looking at an index of 30 stocks. When I move to 500 stocks in the S&P 500, or 2,000 in the Russell 2000, or 4,500 in what used to be called the Wilshire 5,000 Total Market Index, it has a different flavor because the speed with which the price gets from the bottom left to the upper right in a bull market, or the upper left to the bottom right in a bear market, differs by each asset class, sub-asset class. Okay, I promised myself I wouldn't go into portfolio theory and how I construct portfolios, but I see I'm going to need to do that at some point here before this hour is over, and we're still only got 30 minutes to go. So now what I'm going to do is I'm going to get out of the 7 and I'm going to pull up the long term. Now all of a sudden, what you're looking at is a line that very rarely in an uptrend shows price anywhere near it. The first one, the shortest one, went right through it and you couldn't even see it. The second one, the intermediate term, hugged the bottom and very rarely could price get below it, but it was a touch point all the way up. This monster only identifies real possible danger, and that's why it's designed lengthwise for this particular asset class, meaning a broad index, differently than I would use for other asset classes. Let's go back into time. And again, we're talking what is a trend? And we're talking about a trend is determined by the asset class. And a trend is overlaid with your definition of what you're trying to achieve as a speculator, a swing trader, a gambler, or an investor. You will notice that we went through a very difficult period in this trend when we took it back far enough you couldn't even tell. But this lasted basically when price finally broke here. It said something was wrong because there is an entire bar below the long-term moving average. By definition, I would have taken money off the table there, and we're going to get into that in detail in our last hour. How you position and how you use Consensio in general, and then specifically by asset class, all the way down to individual stocks. And we're going to look at about 50 individual stocks. And because of the time limits, we're going to do it quickly, but they're the ones that many of you have been asking us about and are concerned about. Okay, so I have said when we have looked at the Bitcoin charts, let's just forget what we're looking at. Let's take all the moving averages off and look at the price, and then let's take the price off and forget what it is. I know you all hate hearing it, but the more you hear it, the more I would like you to understand how important it is to me in every decision I make. Don't tell me what to buy. Tell me when to buy it. That's what a trend means. A trend has nothing to do with the asset class, Bitcoin or gold, a currency or a stock. It has to do with there are times to be long and times to be short. And there are times to just sit in a position that's going sideways. In this case, I would not have sold everything because the long-term moving average only flattened out. It actually went slightly down between this period and this period. But when you blow it up, and we will do that with a number of individual securities, you'll see what I mean. As long as this long-term moving average is moving up, this is by definition a bull market. This is by definition a bear market. It was not a significant bear market, but it lasted basically from May 2015 all the way until this point, even though the long-term moving average moved up. I say that because price did not make any headway between these 2 points. And this came in October, over a year later, a year and 4 months later. You could have used Consensio to get out of that whole thing. You would have been whipsawed, which means you would have had to jump out and then in. What you protected yourself against turned out not to be that big. By the time you got back in, you basically had lost a little bit on the downside and lost a little bit on the other side. You don't know that when this begins. You never can. Therefore, you've got to assume it's going to keep going in the direction that the long-term moving average is telling you. And in these cases, you've got to believe it's going to continue in the direction the long-term moving average is telling you. Okay, now I am going to put back this one and this one, and I am going to take off this one. Pretend you can't see what is up here in the upper left-hand corner. This is all you know. This is Consensio in its purest form. There is no price. Has anything changed? The answer is no, because each one of these lines has within it all of the price up to the point and going back either 2 periods or 7 periods or 30 periods. But all of that price, all of that noise, all of those ups and downs and big swings, wicks to the top, wicks to the bottom, closes in the middle, are gone, but these lines don't change. And these are the lines you need to understand with Bitcoin, with Consensio. What you want to do in using this analysis is let the lines speak for you. Don't tell me what to buy. Take the name off of it. Take the fundamentals out of it and see what everyone in the world, everyone, the smart ones, the big ones, the institutions, the individuals, the gamblers, the speculators, and the investors have voted on, because it's showing up in these 3 lines. What somebody says on television, what an analyst says on CNBC, what is written about in the Wall Street Journal or in Barron's or in IBD is unimportant. The only thing that's important for you is this is what is determining the value of your wealth. None of the other stuff is. Not the earnings, not the competition, not the margins, not the balance sheets, not the amount that's being mined or pumped out of the ground. None of that is. The only thing that matters is what is everyone in the world that is interested in this thing willing to pay for it? And what is the trend of that total usage of demand versus supply? Okay. With that, what we will do is we will look at some other charts, because we've only looked now at one, which is 30 stocks in an index called the Dow. And what I'm going to do is I'm going to move this all the way over to the beginning of this year. And we're first going to look at what the Dow is telling us about 2018. And what it tells me is, by looking only at the long-term moving average, is we were at the beginning, we have been ever since, we paused by going flat, and now we are in an uptrend again, right up through the close today at 4 o'clock. That's the long-term moving average. But notice what the short has done. It has cut through the intermediate term, and the intermediate term has turned down. Now I can throw the price back on, but you need to begin being able to picture where the price is when you look at these. You know the price has to be above these. In the pink line, I've already told you that the price is going to every week be somewhere along that pink line. Therefore, you can draw a mental picture of what price is doing there. You also know that this line is going to be in a bull market below the price most of the time, which tells you about what's happened here. You can't turn this pink line down unless the price has dropped below it. You can't turn this orange color or gold color down until the price has dropped below it. You can't get the pink line to go through this line unless the price is lower than that point at which they cross. And you can play around all day with the mathematics involved, but you should be able just to picture it anytime you look at a chart like this, even if you take the price off of it. What that does is it alleviates a lot of confusion that you will get from many, many other technical signals and many, many other fundamental opinions about what this thing is that you're looking at. Because I could put any name on this. I could put Bitcoin up in the upper left-hand corner, and I will find a time where Bitcoin looked exactly like this when you take the price away. And any other stock and any other index going back far enough in time. That's not what we're trying to do here. We're trying to understand the trend movement of these things. They all will move exactly the same because of the quadrant that we're in. It's limited in many ways, not just the ones I've described, but given enough thought, you will come up with a bunch of other things that these kind of financial charts can and cannot tell you. Okay, enough of that. Let's take a look at some other things. And to do that, I'm going to move this little baby down here, and I'm going to come up here, and I'm going to click on that. And I won't go to Bitcoin. I'm going to do that last. I'm going to go to the things that we're more interested in, let's go to another index. Let's go to the NDX. Remember what we've just been looking at, the Dow Jones Industrial, made up of only 30 stocks. Now we're going to go to something that has 100 stocks in it. This is the NDX. The NDX 100, these are the 100 supposedly biggest stocks, they change every day, in the 2,000 some odd stocks in the NASDAQ. Now, we all know that certain stocks that make up these 100 are in deep trouble. And we're going to look at them later today. We're going to look at Netflix. We're going to look at Google. We're going to look at Apple. We're going to look at Amazon. But they're all in this chart. But so are 96 other companies. So I look at this chart and I say, wow, this is something I want to own as of today. Why? Because the trends are up. Yes, there was some noise earlier in the year. Oh, good, I get to hit my button. Boom, boom. There's noise in the beginning of the year. But notice that even though price might have, and let's just take a look for giggles, price might have dropped below the long-term moving average. Price might have dropped below the long-term moving average. But you're confusing yourself. Why do you want to confuse yourself? Get rid of it. Let the magic lines tell you the story. Simplify, simplify, simplify. Okay, so that's my reading on the NASDAQ 100 without knowing it's the NASDAQ 100. It ran into some problems earlier this year, but they were intermediate term problems. It turned the intermediate down. I raised cash. You know that if you've been listening to my vlogs. I said, yeah, we're raising 10% cash. We're raising 15% cash out of this thing. Because things began to happen and turn things down. But then we quickly got back in because what is this called? This is called a bull market. Short term above intermediate term above long term, and all three moving up. So why are you out of it? Okay, let's go back into time, and the NASDAQ acts differently than the Dow 30. Here we're looking at 3 times the number of stocks, and they have characteristics that are different than the 30. Characteristics meaning they're different kinds of companies. And here you went through the same period of time sideways with the long-term moving average. Now, understand that if I right now change this long-term moving average to what some other people do, where they use 100-week moving average as opposed to my 30 or 200. And they use 200 because people use 250 and 14 or 250 and 20 across all charts in all time frames. You can't do that because I can make a moving average that is down here. And none of this came into play. So it's useless. Why have it? Now, it was very useful when you got back into earlier periods because it did turn the blue line down. And price broke down through it. But let's put price back on here on a longer time frame so you can really picture what I'm saying. There's the price. And here it is below the moving average. And here, depending on how you want to measure it, you get periods of time where it actually pulls that average down. And therefore, you should have taken defensive postures. You didn't know it was not going to go down here. But should you have ever sold 100%? I never would have. I didn't. I took defensive measures more extreme than these up here, because look at the difference between what we did to the long-term moving average there and there. Okay. Only 11 more minutes until we get into the usage of Consensio real time against many, many other asset classes, not just big indexes. The first one we looked at was the Dow that had 30. Now we've just looked at one that has 100. Now I'd like to take a look at one that has, well, let's do one with 500. This is the S&P 500. I've been saying that the NASDAQ 100, particularly the FANG stocks, many of which, if not all of which, are also in the S&P 500, was helping the S&P 500 to move up. But remember, on the ND axis, compared to the S&P 500, how quickly on the S&P 500, how slowly on the S&P 500 compared to the NASDAQ. This is 11th of June where we blew through. We were actually higher here on both the closing basis and the top of the wick compared to the old high. But somewhere in here on the NASDAQ 100, we had gone to new highs. On the S&P 500, we did not, nowhere close to it. It took us a long time before we hit this candle and finally really broke out again. That's the differential between having 500 companies and 100 companies and 30 companies, and the quality of the companies that make up each of them. That's where the fundamentals of what is the structure of the things you're looking at comes into play when you're using these moving averages, as opposed to the fundamentals about what makes these things go up and down, which this does not rely on at all. This is simply price. It's the only thing these moving averages are looking at. Notice there's no volume. We're not using any momentum indicators other than these three lines. We're not using stop and reverse points. We're not using McClellan oscillators, or we're not using RSIs. We're not using volume. But it's telling a complete story, and a very important one in terms of the beginning, the middle, and the end of moves, trend moves. Okay, so now we don't have price again. We've gone and we've looked at 500 stocks. Now let's, once again for giggles, look at a couple thousand. This is the entire NASDAQ composite. We came close here early in April, going back into time, where we know there were problems in the market back in 2015. You had the same problems here. Doesn't matter if you're looking at 30 stocks or 100 stocks or 500 stocks or a couple thousand stocks. The basic trends are the same. where they occur, getting into and out of various positions, varies by the asset class. Yes, it's true, these are all stocks, but they're not the same indexes. They represent different things, and therefore you use each one separately depending on where your money is going into or what you're trying to get out of, positions you're trying to get out of. We'll put the price back on with this longer term view of the NASDAQ, just to show once again that the pink line stays with the price no matter where it goes. That's why I use the short term. It's an early warning. It's a canary in the coal mine. The intermediate term basically has price above it through up moves and below it through down moves. Above it and below it. That's what the intermediate term is designed to do. The long term ignores all of that and keeps you thinking as an investor in what the trend is telling you. Now, could next week change a lot of things? Of course it could. But next week has not happened. Wait for the evidence. You've got to wait until next Friday. Don't make your mind up on Monday, Tuesday, or Wednesday, which is a shorter term time period. That's not what you're measuring here with this trend. You're looking at this weekly move. You're trying to capture 80% of all upside movements, leaving 10% off the bottoms and leaving 10% off the tops and getting 80% in between. You can't do that if you jump all the way in and jump all the way out, even using Consensio. And you're going to run up big commission expenses if you do, which is one of the reasons I love mutual funds that doesn't cost you anything to jump in and out of. It will irritate the heck out of the mutual fund companies, and many of them will restrict you from jumping around too much. They are not vehicles for speculation or for gambling. But if you're managing billions of dollars using mutual funds, and you're looking for the long-term trends, which is what everybody needs to look at to make money over the long term, not jumping in and out and ignoring trends the way Edson Gould explained it, but catching the major part of the fact that for the last 100 years, all of these indexes have gone from the bottom left to the bottom the right of all the charts and still continue to do it right up through an hour ago. We've got about 4 minutes to go. I'm going to throw in one other thing that looks very different, which is the Russell 2000. And I say it looks very different, as you can see, because now we've got an entire candle for the week as of 2 hours ago below the long-term moving average. We didn't see that on any of the other charts. Notice also that the small cap stocks penetrated 6 different weeks here below that long-term moving average without turning it down. And here again for 4 weeks, and here again for a couple of weeks, and here for a very long period of time. You can see how severe this downturn was when you look at this particular sub-asset class, which is a part of the entire stock market, but it's just small companies between 500 million and $2 billion. They act differently. They are more volatile. When things like an asset class is more volatile than other things you are looking at, you need to look at them and change it. Change either the moving averages you're using to make sure the pink line stays in the middle of the pricing, which it does here, the intermediate term gets a little sloppy here, where the intermediate term very often is violated in small pullbacks. I would change on the Russell 2000 the length of time on the intermediate term, just glancing at this very quickly. Okay, we'll get into details of that in the next hour. So in the first hour, we talked in general about what the heck this thing is with these three wavy lines. And the three wavy lines we were using was price and two other moving averages. Now we've expanded it out to three moving averages in price in order to identify trends, short, intermediate, and long term, using big indexes. We're going to see how this changes tremendously when we look at things even more volatile, like Bitcoin, like individual stocks, like sectors, and like industries. And we will do that in a couple of minutes. And with that, I am going to clean this mess up and get back to what I want to talk about when I come back. And if anybody wants to take a little bit of a break, this is the time to do it.